I would like to see your photo.
Yes, sir.
Yes.
We'll
Just
join,
for a
sir.
minute, and then you can go mute it.
Sure, sir.
Yeah.
So can we start?
Yeah, I'm waiting for you guys. So
Yeah, thank you.
You want to jump the introduction and then I can start? That would be wonderful.
Yeah, just 2 minutes will not take much time, sir.
Yeah, still have 2-3 minutes.
In a global economy, diversification isn't a choice, it's survival. And crypto offers a new frontier. Good morning, everyone. I'm Deepika. A warm welcome to everyone for today's webinar on using cryptocurrency to hedge and diversify energy and agricultural portfolios. To officially begin today's proceedings, may I now invite Dr. Pushpa, Associate Professor, MPBIM, to deliver the welcome remarks and extend our greetings to our esteemed speaker and participants.
Thank you. Good morning, everyone. On behalf of MP Birla Institute of Management, Bengaluru, I warmly welcome you all to today's webinar. As an institution with a strong legacy of delivering professional management education successfully, MPBIM is committed to equipping future leaders with the knowledge and global perspectives necessary to navigate a rapidly evolving business environment. Through events like this, we aim to bring cutting edge ideas and real world insights to our academic and professional communities, encouraging continuous learning and dialogue. As we witness growing interest in the strategic use of crypto assets, today's discussions will shed light on the potential of crypto to manage risk and add value to portfolios in the energy and agri-commodity sectors. We are deeply honored to welcome Dr. William Ganze, Professor and Department Chair at North Dakota State University, USA. Despite his demanding schedule and the late hour now in his time zone, Dr. Ganze graciously agreed to be with us today. His presence speaks volumes about his commitment to academic collaboration and knowledge sharing, and we are truly grateful for this. I also take this opportunity to extend a warm welcome to the management, faculty, staff, student executives, and our valued participants from academia, industry, and the investment community at large. Your presence enriches this platform and makes such meaningful conversations possible. Thank you.
You want me to start now? Should we start or I should wait for? Okay, go ahead.
Thank you, ma'am.
Sorry.
Thank you, ma'am. We are honored to have with us Engineer N. Ramanuja, Chairman, MP Birla Institute of Management, a distinguished leader with an illustrious career. As a founder chairman of MP Birla Institute of Management, and former chairman and MD of HMT Limited, he has made significant contribution to management education and industry. He has also established Bhavan's schools in several cities. Sir is also awardee of Karnataka Rajyotsava Award, Officer de l'Ordre National du Lion, Senior Engineer of Excellence, Foundation Day Award, and many more. We welcome you, sir.
Thank you. Thank you. Thank you. You want me to speak?
Yes, sir.
No. Dr. Ganji, it is a
Yes.
great pleasure for all of us to be with you today in the early morning. As you are aware, today is Saturday in India, and it is a great day for Indians because it is Shravana Shanivara, second Saturday, and the whole India is very busy going to temples and praying and things. I am also very happy that all the participants now are also feeling like they are in a temple of knowledge and steered by Dr. Ganje, our friend from NDSU. And you are always a great inspiration to all of us. The moment we signed our MOU with NDSU, you became part of us and you visited us many times. You addressed our students and staff. You encouraged us. You also invited a lot of our people and you accommodated them in your own place and took care of them as if they are all belonging to your family. Dr. Ganje, we are delighted to have you today morning, and it will be my pleasure to welcome you and wish you all the best. And I now request you to share your ideas with all our people who are eagerly waiting for several days. Thank you, sir. Thank you very much.
Thank you. Thank you.
Thank you, sir.
Yes.
Shri V. Muralidhar, Vice Chairman of MP Birla Institute of Management, brings with us decades of rich experience in finance and international academic exchange. His unwavering support has consistently strengthened the Institute's initiatives. I now invite Sir. Thank you, sir. It's now my privilege to invite our respected Dr. S. Satyanarayana, Principal, MP Birla of Institute of Management. We welcome you, sir.
Thank you.
I now invite student executive Ms. Vijeta to present the formal introduction of a distinguished speaker for the day, Dr. William Gange, a renowned academic and thought leader whose insights we're eagerly looking forward to.
Dr. William Gange, an honorable professor and chairman of the Agribusiness and Applied Economics Department at North Dakota State University, possesses a rich academic background, including tenure at Arizona State University. Dr. Gange brings unparalleled expertise in agricultural finance, agribusiness risk management, and food safety economics. His groundbreaking research explores innovative market-based solutions, including blockchain and cryptocurrency applications, to mitigate risk in agriculture and food supply chains. A prolific collaborator and published author, Dr. Gange has worked with government agencies, academic institutions, and international organizations, earning numerous awards for his contribution to applied economics and teaching, including the prestigious 2022 Best Applied Economic Professor Award from the American Applied Economics Association. We welcome you, sir. Participants, kindly note, mute yourself throughout the webinar. We request you to post the question in the chat box. It will be addressed by the resource person at the end of his session. I request Dr. William Gange to take over the session.
Thank you very much. I'm going to go ahead and share my screen. Let me do that. Yes, I don't know. Hold on a sec. Let me do that again. Oh. I'm trying to share my screen, but I see this wizard was on there. Let me see. Okay, maybe I should be able to share now. Why is it not taking my share screen?
Yes, sir. We are able to see.
We are able to see your screen, sir.
Okay. See, I'm clicking on it. It looks like it's already shared.
Yes, sir. It is already shared, sir. We are
So
able
you
to
can
have a look
start.
at
We
it,
are
sir.
able to see the screen, sir.
You can see my
The
screen with
PPTs we are
my,
able
I
to see.
cannot see it. I see the management logo, but I cannot see my screen. So, oh, hold on a sec. No, I cannot see it. Should I send you the presentation and you share it on the screen?
Sir, I think you'll have to split the screen so that it's visible.
Okay. Oh, I see it now. It's there. It's there. Okay. Wonderful.
Okay, sir.
Okay.
It's
Wonderful.
fine.
Okay. Can you all see my screen now?
Yes, sir.
Okay.
Yes, sir.
So I don't know if it's big enough, or let me share. Share. Then it disappeared again. There's some stuff happening. I click share. Okay. Okay. It's showing that it's sharing, but when I click share, okay. I'm just
Yes,
gonna
sir.
use
If
it
in
like.
case you want that from our side, we'll do it, sir. If you can share it, we can definitely do it.
But you can see my screen. Is it big enough or it's too small? I'm trying to make it bigger. Okay. So let me
Yes,
just
sir.
Is it big enough? Yeah, there's some problem. I think somebody has to stop sharing so I can share conveniently. Somebody needs to stop sharing. If you can stop the host, can stop sharing everything that is on the screen, then I can
We
load
can
it
see the
back.
screen, sir.
Yeah, I know you can see it, but I cannot play with it. I cannot move it back and forth because I see multiple screens that are shared.
You can share it to us, sir.
Okay, I'll send it to you. I'll email it to you right now.
Sure, sir.
Mail.
But if you just stop sharing everything on the screen, I load it again, it will be perfect. Can you stop all shared screen? The host. And the host just stop sharing everything.
Yeah, sir.
Okay. Have they stopped sharing? I'm just emailing the presentation to you, so. I'm sorry for the technicality. Oh, no.
Have you shared the PPTs to the mail?
So I am, okay. Perfect. It's perfect now.
Yeah,
It's perfect.
it's done.
Okay, it's perfect. So I can see my screen. So I just wanted to thank all of you guys for being here. And I know this is going to be a very detailed presentation, and it's going to be a very loaded from the academic side. I know there's some professors here, some academics here. I'm not going to spend too much time on the equations. I have them all here, but I'm not going to spend a lot of time explaining those equations. So I've highlighted what is really important. And but the tables and the equations, if somebody wants to ask questions for clarification, that's fine. I'm going to go ahead and answer those questions. So I'll make the presentation as lively as I can. And if possible, we can take some breaks while we're doing this presentation, because I know 2 hours is a very long time. Some of you guys will get tired. So after about an hour, I'll do my best to do the presentation in about an hour. Then we'll open it up for question and answers for another hour. So I want it to be very lively. And so cryptocurrencies, what are some of the issues and motivation why we're doing this research, especially in energy and agriculture? You all have seen sometimes economies like North Dakota, for example, we had a major oil boom in the United States in fracking, oil and gas. We are number 1, number 2, or number 3 behind Texas in oil production in the US. So we made the United States energy independent. However, if we keep mining the oil and gas in another 70 years and we don't diversify, oil and gas will dry up and that community will become a ghost town community. So we've seen a lot of countries like Qatar, even though they had a lot of oil, they are diversifying heavily into renewable oil. So we've seen Mexico spend a lot of money to hedge their energy sector. So diversification is important because it preserves community and it makes sure that those communities can last for a long time, even after the renewable fuel or oil and gas is long gone. Then the second point that I have here is the traditional diversification strategies that have been used for energy portfolios. They have focused mostly on the energy sector. So for example, oil and gas, renewable energy like ethanol, solar, wind, nuclear. They've not really branched out that much to diversify their portfolio. It's the same thing with agriculture. And this is wonderful. Like in agriculture for us in North Dakota, we have agriculture and energy is huge. And we're trying to diversify into agribusiness, which is processing. We have 2 crushing plants now to crush soybean. So we can do soybean meal. We've seen increased livestock in the state, and we can now create more employment in the state to take care of our own people. So diversification, the traditional way, is very good, but we've been experiencing globally, we've seen unprecedented uncertainty driven by geopolitical tensions. You guys know what is going on in Ukraine. You know what is going on in the Middle East. All of those things affects markets. So one day you might have a very booming oil sector, and the next day, for example, that drops significantly. We experienced that in 2008 when we had the global financial crisis, and the oil sector went from about $160 per barrel to about $40 per barrel. And when that happens, like us in North Dakota, they start cutting employment, they start cutting. So it's very difficult. So we've seen an emergence now with this new wave. So again, I'm just continuing with the issues that we have. Investors are trying to reevaluate. I don't know, somebody went on the screen. Somebody touched the screen and that stuff. Sorry, I don't know what happened, but I think like somebody scrabbled something on the screen. Can you guys hear me very well?
Yes, sir. You're audible. We'll just try to control this, sir. Sorry.
Yeah, I don't know. Somebody scribbled something on the screen. So investors and corporates are rethinking or reevaluating traditional risk management framework, especially for energy and oil. Okay, so this webinar, we want to look at the role of cryptocurrencies such as Bitcoin, Ethereum, and then you have other, we use the setting a different number of coins in a non-traditional hedging mechanism and portfolio diversification in energy and agricultural sector. This section will delve more into strategies to alleviate cryptocurrency commodity price volatility, enhance asset diversification, and navigate the dynamic landscape of decentralized finance. You all know I'll talk a lot about these different areas. What is crypto? What is diversification? We'll go deep into all of those. So just be patient with me. Emergence of cryptocurrency. All of us credit this to Nakamoto in 2009, saying, okay, we need something to go away from middlemen and all the central banks. So cryptocurrency came into place. I'll also talk here how you mine cryptocurrency. And I want to also give credit to one of my students that we work on this research together. I have a student who we're working on this paper to try to get published. We have not even submitted it yet. So we're trying to do that in the next few weeks. But cryptocurrency is now, I tell a lot of people, if you come to the United States, the majority of the young people have cryptos, all of them. So I experiment with it. I invest in some crypto just to understand the market, how it fluctuates. I'll give you a good example. My daughter put in $1,500 in one coin, got up the next morning, and that coin was close to $20,000. The volatility in the market is amazing. There's a lot of money that can be made out of crypto, but you can also lose a ton of money. So looking at it from the perspective of diversification is very interesting. This is how, when you look at crypto, this is the transparency taking away the middleman. So you have, for example, user A will initiate a transaction, and then that transaction will go into a network or computer. The nodes will validate that transaction. So then after it is once again validated, there will be a new block that is added to the existing blockchain. So we have a bunch of blockchain currencies that are going on. And then user B will receive the crypto from user A. The beauty about cryptocurrency is that, yes, it's taking away the middleman from the system, but it also can be mined by companies. So different companies can mine crypto and then use that as a way to help diversify their portfolio. The use of crypto, you all use crypto now. I don't know how much students and folks in India use crypto, but like I said earlier, almost all the young people in the US, they do have crypto. The majority of them have crypto. It's used as an investment, can be used to pay bills, and then you can mine it as a company. And the reason why companies mine this, they're doing it now so they can diversify their portfolio. But the challenge we have is that even though they say they want to do that, they've not really understood the mechanism of how effective crypto is in terms of diversifying, especially portfolios. And we want to focus on energy and ag. Why? Why energy and ag? So as I'm speaking, sometimes I get worried if everybody is hearing me okay. So is it okay? Are they hearing me okay? Is everybody
Yes,
getting
sir.
me? Okay, okay,
Yes, sir, we can
wonderful.
hear.
I will be doing that as I go on because sometimes you lose something happens and you're talking and people don't hear you. So I'll be asking from time to time if everybody's understanding what I'm saying or getting me. All right, so some observations. You can see some of the companies here that have mined crypto and they're trying to use it for their portfolio to diversify their portfolio. And then the big one is we'll have cryptocurrency hype drive diversification in agriculture and energy. And why agriculture and energy? These are two major sectors. Agriculture and energy, they go hand in hand, especially with renewable energy now that you can get from ethanol and other biodiesel. But these two sectors are very dynamic in supporting any economy. For example, most economies, if you don't have a solid agricultural sector, I remember sometime in way when we had the food crisis and we're rationing rice. And some economies can actually go into crisis when there's food shortages. So the agricultural sector, we need sufficient food security, lower price. We need all that stuff. Stability in that sector is critical. Same with the energy sector. I will tell a lot of folks that the only difference between developing economies and developed economies is the energy sector. If you don't have good water and electricity, you cannot develop. So stabilizing and diversifying this energy sector is critical for most economies. Another observation that we made, sorry, I went back to the other one. Another observation is the volatility in these sectors. Like I talked to you guys before, you can see what weather can do to the energy sector. Winter storms, you have some severe peaks and some severe dips when you have some of those weather issues. And what are some of these issues doing? This is the volatility that I did not really mention. You have look at the peaks and the movement in the energy sector in a very short time. You can look at the 2008, like I said, you had that crisis. So you do have some severe volatility, and it does highlight a critical area that we want to reduce risk and stabilize our economies. And when we have those type of fluctuations and diversification, this is what has happened. We've seen increased bankruptcy filings when that energy sector or the ag sector fluctuates deep and you have a crisis. You have some of the banks that borrow money to this sector to finance their operations, whether it's the energy sector or the ag sector, they go bankrupt. And we've seen increased bankrupt. So it's not just companies or governments or sectors that are interested in making sure that these two economies are stable. The banks are also interested to make sure the economies are very stable. Then the agricultural sector, you can see the volatility here. Look at I know this graph sometimes is too small for you guys to see, but if you look at the yellow line on the graph, that's the number of farms that we have in the US, for example. Sometimes we see significant decline. You have the number of net farm income is going up and down. There's a lot of fluctuation. And some people will be like, hey, why do we have increase in net farm income and increase in farm income and overall between 2001 2024? You know, the Russian-Ukraine war, what it did was it increased input prices. So Russia, that area produces a lot of potash, fertilizers that we use for agriculture, but also most of the logistics were destroyed. So grains could not be moved through the normal channel, and the United States benefited a lot because we saw an increase in commodity prices during that period. So there's volatility. Sometimes the prices go up, sometimes it declines significantly. And we want to make sure that we can manage those. Then this is some other stuff with the agricultural sector in the United States. And again, this is in the United States. I didn't have time to pull some data for India. But you can see the number of farms that we have is declining rapidly and significantly, but they're getting bigger. On average, farm size is getting bigger. The average farm size here, for example, is about 2,000 acres. And one person with a combine can farm all of that in no time. But we're also seeing farmland is kind of stable. There's some of these issues with agriculture, and everybody is concerned that, okay, with farms declining, policies that we're seeing changes in policies, are we going to be able to feed ourselves? So everybody is questioning that, and we want to protect that. So I want to talk a little bit about, and again, I have a lot of materials that I've prepared. I'm not going to focus on, I'll just focus on one or two highlights for each slide so that people can have an opportunity to focus on that highlight. For example, the highlights that I highlight in red. If I go through the entire thing that I prepared, it will be boring. So I just pick one or two things to focus on. So despite the attention on Bitcoin investment potential, limited research on speculative assets in portfolio has been done. So this is a speculative assets. Like I mentioned before, if you go to those traditional sectors, the two ways that we're diversifying, we are not using speculative assets, we're using real assets. So for example, if we want to diversify oil and gas with ethanol, those are assets that are traded in the market. But this is new, looking at speculative assets as a tool to diversify our portfolio. So that's why this is very unique. So the objective, what we're going to do, and again, this is where this research that we've done becomes seriously important or has a big contribution in the literature. In the models that they've used for portfolio diversification, they've used Sharp Index, and to an extent, they started using models like CAPM. I'll explain those models as we go on in the presentation. APT, arbitrage pricing model. CAPM is a single asset model. It just uses a market index. For example, in the US, S&P 500, and that's CAPM. APT, the difference is you have multiple factors, and I'll show you guys some of the factors that we estimate. So you can have, for example, a market index, like S&P 500, you have the NASDAQ, but you can also have inflation added to the model, and you can have some other macro variables added to the model, so that when you estimate the equation, you might have a better representation. But previous studies have shown that whether it's CAPM or APT that you use, I've done some work with machine learning CAPM on how to make it more stable. And I did show in that paper that we use machine learning CAPM, is that if you use machine learning, whether it's CAPM or APT, they are all robust estimation. And the reason why these two models are very robust sometimes is that they are working on mean and variance. All of you know how to calculate averages or mean, and all of you know how to calculate variance or standard deviation. So APT and CAPM model, they are functioning on those two moments. The first moment is the mean or the average. The second moment of a distribution, if you take statistics, they'll say standard deviation. But if you look at the distribution of prices in crypto and most of these markets, they have fat tail. So they don't go with the mean and the standard deviation. And almost all the studies that have been completed so far, they are focusing on the mean and the standard deviation, either using the variations of the CAPM or the APT model. So we decided to use a model that captures that fat tail, include two other moments. So instead of just using the average and the standard deviation, the third moment is what we call skewness. So your data is skewed to the left or is skewed to the right. And then the fourth moment is what we call ketosis, right? Fat tails. So we're going to include those two moments. And if we're able to capture our diversification estimation more accurately, the contribution that we have here is that previous studies that have been done using CAPM or APT, the estimations are not that accurate. So we have a more robust model that we're going to do in this study. All right, so again, unlike the Sharpe ratio, like I just discussed, that provides simplistic risk adjustment returns, the implementation of the Markov switching CAPM and APT model offer a more comprehensive analysis by including that downside risk. And then we'll be able to estimate the real impact and contribution of cryptocurrency in a well-diversified portfolio. We want to make sure when we give recommendations, whether it's to a state government or a federal government, that this is going to work, it's going to work. And the estimates and the measures that we have are accurate. So we're applying this model to capture those downside risk with the two additional moments. So I'm going to go on now to the lit review. And again, this is a topic that is emerging using crypto. There are some studies that have been done here, a lot of studies that have looked at this. Like I said, those studies, the methodology that have been used do not account for latent variables, that's factor analysis, and then the downside risk, right? So if you have a fat tail or your data is kind of shifted to the left or shifted to the right, and you use some model that does mean and standard deviation to estimate your stuff, it's not going to give you accurate results. What is latent variables? So latent risk factors. Sometimes when I use CAPM, we use CAPM model. What CAPM model does, since it's a one-factor model, you have a Y variable, you have your X variable, which is the market index, and you run a regression, and you get your coefficient, your beta coefficient, and you get your alpha coefficient, which is your intercept term. The challenge that we have with that most of the time is that we might be missing a lot of other variables in the model that are important. So if we're missing a ton of other variables that are important, then even though we might feel comfortable with the results, it's significant, it's good, most people might question that. And that is how they develop APT, arbitrage pricing theory, because they use factor analysis. So factor analysis is kind of like a structural equation modeling. There are many variables that you estimate, take a bunch of factors. So if I have like 100 different variables to include in my analysis, I cannot possibly include all of those. But I can run a factor analysis with Excel stat, which is a Excel framework, and then it can group those variables into like variables. So and you'll see how we did that in this part of research. Then when it groups that, if it groups all of them, this is the energy index. So you create an index for you. This is the energy index. This is the ag index. What it does, it has an error term. In that grouping process, that error term calculates all the other latent variables that are associated with energy that have not been incorporated in this analysis. So that's the beauty of the APT model. Why we're using APT and CAPM, comparing those in this study. Because we will capture those factors. The factors also capture the latent variables. The tons of other variables that are important, they're captured by that error term, and they have not been incorporated. So in a way, you are incorporating almost everything into your analysis, which is a beautiful thing. Okay, let me go down a little bit. Talk a little bit about the methodology now. I know most of you have talked a little bit about CAPM, APT, and then the Markov switching CAPM and APT that we are using in this particular study. But I want to talk first about the data. Okay, so what type of data do you use to do an analysis? Because this analysis is it's complex, it's nice, but if you want to go and do some stuff that you're going to recommend to policymakers and some other people to implement, you have to make sure it's rigorous. So the data has to be rigorous, the analysis has to be rigorous before you can say confidently what I'm doing is applicable or is going to make sense. So this is where we got the data. We use monthly prices from January 2015 to December 2023. And again, this is work that has been going on. We can expand this data to 2024, 2025. But you can see the assets that we're including here, right? So we have the agricultural index. So we have an index that has agriculture processing and production in that particular GSCI Ag index. Then we have an energy index that also have a group of different energy sources. So that is called the GSCI energy. Then we have three different Bitcoins, right? So we have the three different cryptocurrencies. So we have Bitcoin, we have Litecoin, we have the Ripple Labs, and then we have this market index. So the importance of a market index, it's a huge portfolio. Like here, when we say S&P 500, this is like 500 mega companies, right, that have come together to create a market index. So if you watch the news, for example, in the US, you watch CNN or you watch any news, you see on the side, they are putting how the S&P 500 is performing. And that is giving a big story. If that S&P 500 is positive or going up, that means the economy is solid, because these big companies are telling you the direction of the economy. If it's flat, it's telling you the economy is stagnant. If it's declining, it's an indication we might be getting into a recession. So these market index are very important for us when we use it for analysis. We want to understand how it impacts the economy as well. Then these are some of the tests that we're going to do. If you want to do any type of solid econometric work, you have to do some tests to see that the data is accurate, to avoid any type of spurious regression results. So we'll do the stationarity tests. I'm not going to go into that detailedly. We did an autocorrelation test. We did a correlation test. And all these tests, if you don't do them, then the model that you're going to use might not fit. And this is the test that tells you, yes, these models fit, and it's good for you to use them. It helps you to select the appropriate model so you can make good recommendations. So for example, this is the correlation stuff that we did, and look at that. We noticed that crypto have a very weak correlation with both the ag and the energy index, but even weaker correlation with the energy one. However, we notice that the ag has a stronger correlation with the energy than both do with the crypto. So the question now is, okay, we have this crypto that has a very weak correlation. Why are we interested in correlation? Why does it even make sense to even think about correlation? In portfolio diversification theory, there are three major signals or three major indications to show that it's going to be a good asset to diversify your portfolio. One of them is if they both have negative correlation and is significant or strong. And what does that mean? The goal of diversification is to reduce risk, stabilize your revenue. If you have two assets in your portfolio that have negative correlation, then if one of them is increasing, the stock market is going up, the other one will be going down. So it ends up stabilizing everything. If you have both of them a positive correlation and significant, they all will go up the same way and they all will collapse the same way. So you can make a ton of money and you can lose a ton of money, right? So correlation is very important. That is one aspect. When we look at diversification, we look at correlation. The other aspect that people don't see is what we call economies of scale or economies of size. And the bigger a company is, then that company by itself is already well diversified. They have so many elements in that company to be well diversified. So that's a second element that if you look at crypto, it might be providing that economies of scale or size that will encourage diversification, even though the correlations might not be there. And then the third element that we look at when we talk about diversification, we have three elements. The third one is very important, okay? The optimum number or the number of assets in your portfolio. If diversification can define it in very simple terms, don't put all your eggs in one basket. Literally, that's the definition of diversification. And diversification is important, super important, because it doesn't only tell you not to put all your eggs in one basket, involving multiple assets, but it's also the only tool in risk management that completely eliminates risk. The other tools like hedging that we use, forward contracts, those transfer risk from one person to the other. If I am doing hedging or I'm doing forward contract, there's going to be a loser, there's going to be a winner. So it's just transferring risk. But diversification is one of the true risk elimination tool. Even insurance, which is a mega risk management tool, is transferring risk from one person to the other. There's a company that takes it on. So if you get an accident or something happens to you, they'll pay. So that's why diversification is very interesting. And most economies or governments are focusing on diversification. So just to go back to that slide, even without the negative correlation, because some people will see this and say cryptocurrencies are not fit. The correlation is too weak from just a naive perspective. But then when you go and look at those two other factors, you'll be like, okay, there's a potential here for cryptocurrency. So now, covariance, again, I will not go deep into some of these slides because I'm using them just to show background stuff. And so I've been talking about diversification. What is diversification? I've explained it a lot. And this is something I know those of you who do not like math, they just hate this type of stuff. They look at these equations, they already have a migraine. So I don't want to look at this. My MBA students, please bear with me. Okay, I'm going to take some time and just explain that one equation that I highlighted in red. So it's not very complicated, it's very straightforward. I'll explain that because this is the core equation we use for diversification. So I want you to understand that equation, and then when we go into complex stuff, you know what is going on in the background. I don't want to talk about this whole research and this whole stuff, and then you don't know what is going on in the background. So in a nutshell, I have the certainty equivalent of my returns that I'm trying to make, right? So I want a returns that I know I will get for setting. If I'm investing in something, I know certainty equivalent is a safe return. For example, in the US, we can use the loan rate. The loan rate, what is the loan rate? The loan rate is like a price floor. You know, the government sets a price floor for farmers that if prices fall below that, you don't need to sell your commodities, the government will buy that. So certainty, for certain, if farmers produce and they have a price floor that has been set by the government, we call that certainty equivalent. That's the YCE, Y certainty equivalent. And then on the right-hand side, we have the returns. So we have two different assets. This is just a two-asset diversification. For example, energy and crypto. So you have for the RI is asset I, just one asset, and then Q is the weight of that asset, right? So if I have $1 million to invest, I can split it into 50,000, 500,000, and 500,000. So QI and QJ will be 0.5 and 0.5. So I'm putting half of my money into energy investment and energy assets. I'm putting the other half into crypto. All right. Then minus, you have the lambda, which is your risk aversion preference. That lambda, you see that stuff on top of the 2, we call that the lambda in math. It's your risk aversion preference. And this risk aversion preference in this study, you see me do a lot of sensitivity with somebody who is risk averse. What does risk aversion means? It just means you need compensation for taking risk. Okay, every time you invest in the stock market, if you're not going to get a return, you will not do it. So I'm adverse to investing in anything that is risky. But if I'm going to get paid, then I will do it. That's what risk aversion means. So in this particular situation, I will do some sensitivity to show that our result is robust for people who are completely risk averse, who will not want to do anything, risk neutral, they don't want to take any risk, and for people who want to take the highest level of risk and get compensated. We'll do sensitivity to show that our result is very robust. Again, you have 2, then you have the weights, like I said, maybe 0.5 and 0.5, and then you have the standard deviation. All of you know how to calculate standard deviation of asset 1 and asset 2. Then you have that P in the middle of that formula is the correlation. We've been talking about the correlation between asset 1 and 2. All right. And this is the beauty of this. If that correlation is 0, the first part in the bracket there becomes completely 0, right? If the correlation is negative, then that whole part, it magnifies and it becomes negative. So you subtract a bigger portion from the first 2 components, making it risk reducing. That's why if you have a negative correlation, that component becomes negative, and then this whole equation becomes smaller. You know, it stabilizes your revenue even better. So that's a simple equation for 2 assets in your portfolio. We keep expanding this if you have 3 assets, 4 assets, or 500 assets, like we have in the CAPM model. So it becomes a huge equation. That's why we call the CAPM. CAPM is a well-diversified, the S&P and the CAPM, the market index makes it a well-diversified portfolio. And I'll tell you give you some statistics about that. If I run a CAPM model with that S&P or that market index, that beta value is always going to be around 1. So if I do any other stock, if the beta value is less than 1, that means that stock is less risky than the market. If the beta value is higher than 1, and I'll show you some tables at the end to show you that means that stock is more risky than the market. I will require more compensation. You guys know about the terminology, no risk, no gain, right? If you take more risk, you get more returns. So we use that beta factor for the CAPM model to tell us how risky other stocks are. So this is an important model, an important component, and it's kind of really the base of what we are going to do in all of this in terms of when you hear the CAPM model, capital asset pricing, it's a model that we just use to price stocks, to price the return and the risk, to understand what is the return and the risk of any stock using one factor. The APT, arbitrage pricing theory, is the same, but now we are doing the returns and the risk with multiple factors, okay? And that market index is a diversified index, and this is what is being programmed in there when we estimate that. Okay, so this is an example of all the sensitivities that we're going to do with that risk aversion parameter. You see risk neutral, that table, use risk neutral is 0. So we'll put 0 in there and see how the results will change. Then we'll put hardly risk averse 0.5, normal or somewhat risk averse 1, rather risk averse 2, very risk averse 3, extremely risk averse 4. That means somebody who doesn't want risk at all. If they're going to do anything, they don't see the benefits of doing it or a strong compensation, they're not going to touch it. That's what we call extremely risk averse. All farmers are risk averse. I always tell students in my class, you know, when they drive, especially students never drive speed limit. So I tell that all students are risk averse. Now they are risk takers. They are not risk averse because they don't need compensation to take risk. They drive fast and they might get into trouble. All right, so I'm not going to talk more about this. I'm not going to explain this. This is just for people who want to ask questions later on. Come back to the theory of diversification. I can answer those questions for you guys. But for the general audience, I'm not going to do that because I'm going to put a lot of people to sleep. You know, it's going to be boring. Okay, and this is the CAPM model with its assumption. Again, if you want to ask me questions after this, I'll get into that in more details. I don't want to make anybody feel like this stuff is boring. So here is the main equation for the capital, or what we call the capital asset pricing model. It's a regression equation. It's simply an equation of a straight line. You all know what the equation of a straight line is, right? You know y equals to mx plus b. That's the equation of a straight line. That's what this is. And that slope of that straight line is what we call the BI, the beta index. It tells us the riskiness of that asset. And then the RMT is the excess return on the market. This is where I require compensation. So I take the return on a stock minus the risk-free rate. A risk-free rate is like you have a T-bill, T-note, or a bond. In the US, if I go to the bank and I say I want to buy a certificate, a paper, put my $3,000 in that bank for 1 year, and they'll give me 2%. I come back after 1 year, they'll give back my $3,000 and my 2%, risk-free. They're not going to tell me that, oh, no, your money evaporated overnight. Because those T-bills, which is 1 year and less, T-notes is between 1 year and 5 years, and then T-bond is greater than 5 years. Those are all risk-free assets. So we'll subtract the return on this and then minus that risk-free. That's where you get RM, excess return on the market. And then you have excess return on the stock. On the left-hand side is the return on the stock minus the risk-free. Any of those risk-free, I'll show you the one that we use in this study. But this is the CAPM model. Then you have the error term, the EJT, that is the error term. And sometimes that error term can be very low because we only have one factor in the model. We know that there are almost 99 or 100 other things that are not included in there. So when you see a low R squared, it's not surprising. Okay. And this is some of the results that we have, or not results, but just descriptive statistics that we saw with the data. You look at this CAPM stuff, you look at the beta value, the riskiness. So now I want to juggle you all's memory. Okay, I want to juggle everybody's memory. I said when you have, for example, the beta, look at the beta of S&P 500. You guys can see that beta is equals to 1, right? S&P 500 beta is equals to 1. The beta is what we use to measure the riskiness of anything, of a stock. So now I want to ask you guys, if somebody can pick this for me, I know it's in the middle of the presentation, but look at the ag index. The beta is only 0.242. Look at the energy or the Bitcoin. The beta is 1.63. Can you guys see that? Can you guys see that line, the beta, on that table? This is super important. That tells you agriculture is super low risk. It's way lower risk than the market because the market, the beta is 1. How about crypto, Bitcoin? High risk. Look at all those cryptocurrencies. They are all very high risk, right? So you look at the Bitcoin, 1.63. Again, just look at that beta on the table, 1.63. XRP, 1.77. Litecoin, 1.63. They are all higher than 1. That's telling you that Bitcoins are way more risky. Energy is also higher than 1. That means the energy sector, the risk with the energy sector is higher than the risk of the market. Most people like agriculture in the US. They love agriculture. You look at like Bill Gates is the biggest farmland owner in the United States. And he'll rent out that land, people will plant and farm. Why? Because agriculture is the lowest risk and you can use it to diversify your portfolio also. So people are using agricultural stocks to diversify because agriculture is heavily subsidized in a way. So it's very stable. We have crop insurance, we have the loan rates, price floor, we have all those things that support agriculture. So it's very low risk. But you can see now, even the agriculture, even though it's low risk, but we've been experiencing a lot of decline in revenues, so it's important to look at ways to mitigate some of the risk and then stabilize returns. All right, so this is the arbitrage pricing model. I've already talked a lot about this, that the only reason it came into existence because the CAPM is only one factor, that market index. But now if we want to add inflation, we want to add any other variable, any macro variable, the war in Ukraine, COVID-19, want to add those variables, then we have to use the APT. I know there are some models that have adjusted, CAPM models adjusted for inflation, but we use the APT because it's a factor model. Number one, it captures latent variables that we have not included in our analysis. Those latent variables are important because I want to talk about my model is robust. I'm looking at other variables that the other models didn't look at. So it's very important. Okay. Again, that's the APT model. It's similar to the CAPM model. The only difference is multiple factors. And this is how we estimate the factors. I will show you some results so it's more clear. And then we have the comparison between the APT and the CAPM. Again, most of the studies I've done, I do use both, and both of them have very valid results. The results are very comparable. The only difference is that the APT has several systematic risk factors. The CAPM only has one. And people always ask this question, you don't have all the variables in your model. Your model is lacking a lot of variables. So for those who are doing research and some students who are trying to run regression, it is not important that we have all the variables. If we have a theoretical model that has been proven to be robust, you can have one variable and you still explain a lot. So it's not shooting down the CAPM. It's just making sure that they are fit, they are good for different reasons. And then, again, these are just procedures, how we estimate the equations and all that stuff. Then this is the higher order moment portfolio theory. This is where we start making our contribution. All the other things that I've been talking about is just basic things that in finance, we use that, all those things all the time. But this higher moment portfolio theory is where we add the third and the fourth moment to our analysis. And we feel like this is why this paper is going to get published in a very good journal, because we're going to make a very good contribution. And then this is the formula that you use to calculate skewness. This is the formula that we use to calculate ketosis. Again, remember, skewness is the third moment. So you have the mean or average is the first moment in statistics. I'm talking statistics language now. That's the first moment. The second moment again is what? Standard deviation. So it's deviation from the mean. The third moment is skewness. The last moment or the fourth moment is ketosis. So those are the ways we calculate those. Right. So again, this is our contribution, this Markov switching regime, CAPM and APT model. And you can see that last sentence that I highlighted in red is telling you that the market skewness factor is included, is squared, right? And then the market ketosis factor is raised to the power 3. It's kind of small, but I hope you guys can see that. It's the same like the traditional CAPM model, but we are adding this, the excess return, we square a factor, we make it square, and then we also make it triple. We multiply it times 3 or times itself 3 times to capture that skewness and ketosis in the model. So again, that's the methodology. I know it's a little bit deep into that, but I like you guys to, for those who are academics, I know they will enjoy it. For the MBA students and other folks, they might not like it, but I always like to give a detailed presentation of the methodology because it does support whether the results that we are doing are valid or not. So we're going to go down to the results. Okay, so again, the results, I know I highlighted this before, and you saw the 0.24 of the agricultural beta, the beta of the agricultural index. This is when we estimate this. So agriculture is really low risk. And then you have the energy is still higher risk, and all the cryptos are higher risk. So I'd estimate these results before. Alpha is just the intercept term. So the beta are the coefficient, the slope coefficient, and then alpha is the intercept term. So the residual term, if you run a regression, you have that inside the residual term. If nothing is happening, that's like where it hits the y variable, the line hits the y variable. You call it the residual. All right, so this is very interesting. I want you guys to see this because we're using that LS stack, which is sort of an extension of statistics, to run the factors. We have all these different things. We want to load them into different factors. Here we have 3 factors, and we are using a non-restrictive factor modeling. So we said, give us, if it's going to load into 4 factors, so be it. If it's going to load into 2 or 1, group them for us and tell us which ones are going to group in the same factor. If you look at factor 1, you see all the Bitcoins, all the cryptocurrency loaded into factor 1. That's what I highlighted in red. So you can accurately say factor 1 is a depiction of the cryptocurrency, an index for all the cryptocurrency combined. But it also captures now all the other cryptocurrency, the latent ones that are not included in this model. It captures all of them. Then factor 2, look at factor 2. Factor 2 is the energy factor. It captures the energy index and the S&P 500. And then factor 3 is the agricultural factor index. It captures agriculture and inflation. So this is, when you run this factor model, you don't know what you expect, but it comes out to be very unique because it groups them. This is one of the things that I like because numbers really don't lie most of the time. It groups them for you, and you can see that, oh, these groupings really make sense. Again, so when you do the factor, you just put your data in Excel, XLS in Excel, and then you run it. It's going to do these groupings for you, and it's going to give you the factor scores, all those cool things. All right. So now, so again, we run our regression, the risk premium. You remember what factor 1 is? Factor 1 is all the cryptocurrencies. So you see the risk premium is negative 10.88. Factor 2 is positive, right? Factor 3 is even more positive. That's the agricultural one, right? So there's a bigger risk premium. What does that mean? It means if you have a low risk premium, most of the time, and this is important, Because even though agriculture is showing that it's low risk and it has a bigger risk premium, right? This is a kind of unique situation. Most of the time, low risk will give you low risk premium, high risk will give you high risk premium. But this is setting the stage to tell you that there's a room to combine factor 1 and factor 3, and then factor 2 and factor 3 in the same portfolio. So these are the factors that we have, and those are all the things that we'll start combining. So we'll go ahead and combine, do a lot of combination, and then use some methodology to capture our optimal portfolio weights. So I'm not going to go through these results. We can come back to those. I'm not going to go through that, but I want to start showing you here. Look at the combination. This is where we start really doing the study and looking at, is cryptocurrency going to be helpful in diversifying our portfolios? So you can see we first started with Bitcoin and ag. We went with Bitcoin and energy. Then we're going to go with the factor also. This is an APT. We're looking at the APT model. Then when we go to the CAPM, we'll only use the factors. So we wanted to do both just for comparison. And then if we use our optimum portfolio weights, you see that in this particular situation, the best combination, you have 79% Bitcoin and 39.59% agriculture in your portfolio. You see those weights, hardly risk averse, and all the other ones. I just highlighted that one to explain. Okay. So now let's jump to the results, and we'll talk about the results. Very interesting. We have some very interesting results. So the negative weights indicate we have some negative weights for the Bitcoin or the Bitcoin index or the cryptocurrency index. Indicates that the assets provide a hedging benefit against other long positions in a portfolio. These weights are an integral part of creating a balanced and risk-efficient portfolio. So those are some good things that we are seeing with this cryptocurrency. Then portfolio uncertainty equivalents, kind of similar results. The uncertainty equivalent results is essentially provides a single number representing the returns that would make the investor indifferent, right? So it's setting between a guaranteed returns and a risky portfolio. But I want to go to some of the core results. Those are some results for the certainty equivalent. Those are some results for the portfolios that we did. There are many more results I could not share here, but this is the regime switching, the Markov switching CAPM model. Again, the table is, you cannot read this table. It's a little bit difficult to read, but I'm going to go to the conclusion and then you see the main results. Okay, so this is the Markov switching APT model. These are some estimated volatility for the energy and ag sector. Right. Again, these are some Markov switching results that we got. I'm not going to waste too much time explaining that because there's a lot of people here who probably will not care for those. So I just want to go straight into some of these results. So again, these are some portfolio results. Let me go to the main conclusion, which I have all the results highlighted there. I think this might be the one that most people will really enjoy. And I will come back. If you have any questions, I will come back and answer those questions in detail. But I don't want to put anybody to sleep, start talking about formulas and graphs and figures. So I don't want to put anybody to sleep. So conclusion, these results show that all three cryptocurrencies put together, again, you show we have that factor model, factor 1, with the commodity classes can enhance the overall portfolio performance, making cryptocurrency an attractive addition for an extremely risk-averse and hardly risk-averse investor. So, core results, there you have it. Cryptocurrency can help with diversifying your portfolio for those two groups, those who are hardly risk-averse and extremely risk averse. What does that mean? These are the people who, if they want to do something, they need compensation, and you have to compensate them heavily before they even do it. That's what a risk adverse person is. And then another conclusion that we have here, we're just comparing the results with previous results that we have that have used just the CAPM model, the APT model, that are not as robust. And again, our results show that it's way better than some of the existing results that have been done. These are other comparisons with other studies that have used more simpler methodology. And we have more accurate results by integrating the Markov switching regime framework into higher moment portfolio theory. The study reveals that crypto exhibit a unique behavioral pattern that serves as a relatively portfolio stabilizer during periods of calmness. And this is important. During periods of extreme, like we had that Russia-Ukraine war, the results will not be the same. But when things are calm and we don't have those geopolitical things that are going on or a mega financial crisis, cryptocurrency is very useful in stabilizing your portfolio. The dynamic approach that we use, this help us to capture evolving market and also asymmetric risk portfolios, which we cannot do with the simple CAPM or the simple APT. I'm just picking one or two results and reading them. I don't want to read all of them. So the analysis reveal a dual nature of the cryptocurrency in a portfolio, functioning as an effective diversifier when the market is calm and transforming into a risk absorber when the market is stressed, necessitating careful management of your hedging strategy or your portfolio strategy. So this study kind of provides investors with a robust framework for navigating the complexities of intertrading cryptocurrencies and commodity index, balancing diversification benefits during stress. So when things are not going well. These are just areas for further studies that if you want to go on for further studies, you can do that. So I have been talking for more than an hour. I think it's time for us to just take a little break and then bring it out for Q&A. Get everybody to ask questions. And when you ask questions, I'll go into those. If you want to take a little break, fine. I can continue talking. I talk for a living, so I don't mind continue talking till the 2 hours is exhausted. But we can take a break or just open it up for questions. So what's your preference?
Okay, sir. Participants are encouraged to share the questions in the chat box, so we'll address the aftertaste sometime. After 5 minutes.
Okay, good.
Now, should we leave and then come back or what?
Don't log out. If you log out, then just leave I'll just leave my system, then I'll go use the bathroom for a little bit. But don't log out. You can just come back.
Okay.
Yeah.
I just locked it.
So I'll be back in 5 minutes also.
Hello? Sir, we have participants' questions. We will address after some time, so 5 minutes. So
Is it Dr. Pushpa? Hello? Is it Dr. Pushpa?
Hello?
Is it Dr. Pushpa?
Yes, sir.
So now what should we do? Should we leave and again check in or what?
Sir, we will. Yes, sir. 5 minutes, sir. Wants to take a break. We'll.
No, but I should go. I should leave, or I can just keep it as it is.
You can stay, sir.
Okay, I can stay. Okay.
Yeah,
Otherwise, 100 people are there. We may not get a chance to enter
yes,
back.
sir. Yes, sir.
Okay. Very
Yes,
interesting, isn't it?
Yes, sir. Very informative.
Of course.
And,
afterwards,
for
you
all
have to tell me a lot of things.
Yes,
because,
sir.
As you know, cryptocurrency you introduced with your brother.
Yes, sir.
And I heard, and I think now I should study a little more to understand better. Okay, but it is
Sure,
very
sir.
nicely Dr. Ganjay puts it so nicely.
Yes, sir, with a
Okay.
lot of clarity and
Yeah, clarity and
research
you can
inputs.
seeing is believing. 100 people are continuously there.
Yes, sir.
Okay. Thank you.
Yes, sir. Doc- Hello.
Yeah, I'm back.
Hello, sir. Yeah, thank you, sir. We have some questions in the chat box.
Yeah.
If you can throw light on
Yeah, you
that.
can read them. You
Yeah,
can read
yeah,
them one at
yeah,
a
yeah,
time,
yeah,
and
yeah.
I can tackle them.
So
Yeah.
the question is like this: what are the fundamental differences between hedging through cryptocurrencies versus traditional financial instruments like futures and options?
So, like I said in my presentation, I said hedging with first diversification is really not hedging, right? Hedging is transferring risk to one person, but diversification is just bringing things that will help reduce your risk and stabilize your income. So the difference between, so I was not talking about hedging in this presentation. I was talking about diversification, but you can use it. So let me go back to that question again, right? So what is the difference?
Between
Can you ask that
hedging,
question again?
what are the fundamental differences between hedging through cryptocurrencies versus traditional financial instruments like futures and options?
Yeah, there are different ways. You can use futures and options. You still use those strategies with crypto. You can hedge fumes, what we call fumes. So you're just speculating. These are more speculative currencies. Crypto is a speculative currency. Those futures and options, yeah, you can do them for hard currency. Speculative currencies they're done by speculators. So you take a position in the market without holding a real asset, right? So I can go into the market, and that is what collapsed the oil sector. I think this was in 2007. Remember when the oil prices and the oil market was almost tanking in the US? We're seeing oil prices skyrocketed, just going up, and everybody will produce enough oil in the country. How can we produce enough oil and prices just keep going up and up?
Yeah.
What was happening was speculators for these mega cartel companies were coming into the market. They buy huge amount of oil. They just take a position and then hold it so that oil becomes scarce. Then when price skyrocket, then they sell. So when we realized that's what was going on with this speculation in the oil market, that created an oil market crisis, we decided to put T+3 regulation in place and then a T+7 regulation for transparency. So you cannot hold those positions for more than 3 or 6 or 7 days. And you have to report those positions. So with futures and options, you are not speculating, right? You are taking an actual position in the market, and then you pay what we call, you have basis in the futures market. Options, you don't have the basis. So the futures market, you do some margin calls, you take an actual position, and then when the maturity date comes, you pay your balance, and then you take your commodity. With options, you can do the same, but options, literally, you are taking advantage of upward and downward swing in the market. So you can say I can hold a position in the market. If prices go up, I only lose my option premium. If prices go down, then I can sell it, or vice versa, to make money. So options, you pay a premium, and that premium gives you the right and the guarantee to buy anything at a given price at a given time. And if those things go up or down, the worst you can lose with options is your premium. With futures, you can lose a lot, but option, you can only lose your option premium. That's a little different from crypto, right? But you can do those things too with crypto. There are a lot of people who are hedging with cryptos now. But my presentation was more on diversification. I don't know if that answers your question.
Yes, sir.
Okay.
Thank you.
What's the next question?
Which equity factors like inflation, interest rate, or geographic
I can't hear it very
Which
well. Maybe
APT
one person.
factors like inflation, interest rates, or geopolitical risk are most significant for a crypto commodity hedging model?
Right. So when we talk about factor modeling, we don't go back and talk about factors, variables, right? So if you saw my factor modeling, let me go back to you see the variables that are loading in there. So now they're loading as a bunch, and all I can talk about is, if I can find it. But when we talk about factor modeling, you saw all the cryptocurrency load into factor 1. And then you have the ag factor and the inflation load into factor 3. The beauty about factor modeling is what we call structural equation modeling, very similar. It does have now the error term to account for latent variables that are not even present anywhere, but that's the error term. But now you can analyze and include that in your modeling. So when we talk about the results, we are explaining our results in terms of factors, no longer in terms of variables. But we know what variable loaded into those factors, right? But we're not talking about factors anymore when I explain my results. I explain my results as all the ag index, now one factor. I explain that in terms of that particular factor. I cannot go back and start breaking them in terms of the variables. That's the major difference.
Yes.
Does that answer your question?
Yes.
Okay.
Sir. Thank
All
you.
right.
There is one question from Nikita here. Is there a diversification benefit in carbon, including carbon credits or energy tokens or ESG aligned assets in energy portfolios?
Right. So, yeah. So we've done, let me see if I can really understand the question. So let me see.
Does diversification actually benefit?
Okay, I see the
In,
question.
yes.
I see the question. Is there a diversification benefit in including carbon credits, renewable energy tokens, or yeah, you might. You have to do the study, right? This one, I have included specific variables in my analysis, so I can talk about what I have in my model. I can talk about those three cryptocurrencies that I have. If I want to say whether these carbon credits, renewable energy token, or ESG alignment are going to help in an energy portfolio, I have to do the analysis for that, right? I am the US administrator for NC 1198. The 1198, we are the group that look at ESG as a competitive advantage for medium-sized farms. So we have all the universities in the US, Michigan, Cornell, and I am the administrator. So to do some of those, and a very important question, but that's a whole different study, right? That's a whole study that you can say, okay, let me do this study also and see how the result come out. It's not something I included and I can talk about because I did not include those variables into my model. Does that make sense? If you want me to speculate, there's a potential they will reduce, but I don't like speculating. Yeah.
Okay. We have a question from Dr. Karthika. Is it safe for small investors or students to invest in it? It means maybe cryptos she's talking about. Is it safe for small investors or students to invest?
In crypto?
Yeah.
Absolutely.
I'm assuming
Absolutely. The thing with crypto, what I can tell you is my son, he graduated from college and he was working for a bank. He started his own little company. He has crypto on the side, and then he also does advising into which cryptos should you pick for your profit. He does advise me sometimes, Daddy, watch out for this particular crypto, or pick that one, put it on there. But the young people here in America, they live on these things. Some of them don't even want to go back to work. They don't want to get a job because they make so much money. If they tell you how much money they make sometimes, but you also have to invest a lot of money. I just put around $3,000, $4,000, $5,000 in there just to understand how the market works. That these people are putting, some of them have $1 million in crypto. So the young people there's nowadays, some of them can even retire young, way younger than us. So it's something that I would encourage young people to do. If you have $1,000, go in and play and get some advice from people who are doing it. You might make a ton of money, or you might be. My portfolio in the crypto is very balanced, so I can make good money, but I don't know if I can lose a lot of money because it's so balanced. Yeah. I don't know if that answered your question.
Again, Dr. Karthika, again, she is having another question. Bitcoins are not regulated by SEBI, but why it is promoted?
Okay, so this is a good one. It's a very good question. Excellent question. You know, my take is if you look at the total contribution in terms of currency, it's way less than, I think, even 5 or 10% on the global stage. So I have speculated that when this thing hit more than 10%, they're going to regulate it. That's my speculation. Now, people make money. Even the US government is keeping crypto in their portfolio and stuff like that. And they have put commissions to look at how to do it well. We have mega corporations mining their own crypto. And the idea is it might go counter to why these cryptos were created. They didn't want any middleman. They didn't want a Federal Reserve Bank. It's a free-spirited. You mine that coin or you mine it, you don't own it. You put it out there and you let the market demand and supply dictate. Unfortunately, there have been a lot of speculators who might hold position and jack up the price and then cash out and let people scramble. There have been lawsuits in the US where mega stars have been sued for promoting a cryptocurrency and then it tanks. So there's a room for regulation. And I think the reason why people are doing it now, there's a lot of money to be made out of it. But I'm thinking if the proportion or the volume of currency that is total crypto, for example, in the US, start going above 10% or significantly above 10%, I will see some serious regulation come down. That's my speculation. I don't know if that answered your question.
Yes, sir. Thank you. And we have a question from Yash stating that what are the biggest barriers today to the adoption of crypto in energy or agri portfolio? Is there any barriers, specifically government regulations or any such?
No, the biggest barriers that we have is that studies like what I'm doing now has not been done. And people don't understand those three components that I mentioned during my presentation. Most people just look at correlation as the main factor to determine whether to include something in your portfolio or not. But there's economies of scale and number of assets that I just pointed out that most people don't even look at those two. So as more studies come out, like the one I just presented, that is showing the potential and it's more detailed, it's more complete, I think you'll see a lot of companies entertain the idea of using it in energy and ag portfolio. Some of them are already doing it, but you might see because, the science drives everything. And if people don't have the science or know how to really estimate some of these models well, they're not going to use it. So my hope is that some of these studies that we do will provide a framework for people to say that estimation is robust. And I think we're going to go this route. I don't know if I did answer the question.
Yes, sir. Probably, as you suggested, probably a lot of research is required. Outcomes of the research will definitely become inputs to the policymakers also in the days to come.
Right. You'll be a driver.
Yes.
That's correct.
Yes. And sir, I think we can take the last question here.
Okay.
There's a question from Purvika.
Okay.
What role could AI and predictive analytics play in optimizing crypto-based hedging strategies for commodity portfolios?
That's a great question. That's a really, really good question because AI is the future. AI is the future. And even most of the stuff that we teach now in the university, even here as North Dakota, we begin to realize that some of the things that can be done with AI, we should help students know how to use AI well rather than preventing them from using it. I think in the old mindset is that students use AI to cheat and people use AI to cheat, and then AI has some limitations also, right? AI cannot control effectively quality. That's one of the biggest limitations of AI. They cannot, if I'm doing certain things or certain products, they cannot really control when people are cheating. Yeah, it's going to become more and more important as the methodology to refine to control for quality, to control for cheating, to control for, so that when it's applied in this type of analysis that I've done, you can see increased use of the different methodology or increased use of application and adoption. But I think the future is going to be AI refining a lot of this work that we are doing. How it refines it is going to be depending on those of us who are doing the work. Because what does AI do? It pulls from the research that we are doing now. So once my research is out there and you ask AI pulls from all the work that have been done to give you exactly how to do it best. If there are no work that has been done in that area, you ask AI, it's going to give you stuff that makes limited or no sense. So AI does pull a lot from what we are doing to give you credible information. That's a great question.
Yes. Sir, I think there's an excellent participant, Dr. Ramesha. He's asking about, since Indian economy is in deficit BOP, how can this cryptocurrency influence India to overcome the problem of deficit in BOP?
To overcome the problem of what?
A deficit in balance of payment. Indian economy is in deficit in balance of payment. How can this cryptocurrency influence India to overcome the problem?
Yeah, so again, that's a good question, because balance of payment, it depends on your exports, your imports and stuff. If you have, for example, in North Dakota, we have 2 crushing plants now, and we're creating, instead of importing a lot, we're having our commodities and stuff creating more jobs for us, more employment for us. We don't need to rely too much on China to buy soybean from North Dakota, because we are using the soybean to create soybean meal, soybean oil, renewable energy, and we're limiting our imports of other things. So yeah, if you can create avenues, for example, if crypto can help you create avenues where you can increase productivity from within, and then you can increase supply from within or demand from within, or create other income generating, like I just said, diversification is one of them, right? Create other income generating opportunities. There might be a good possibility that you reduce your balance of trade. I don't know if I understood the question well, but
yes, sir, I think it's definitely answered. And so the last question, I'm sorry, there's another question here from Sumukha. What do you think will be the future of crypto for trading and investing as far as Indian law and regulations are concerned? Being an emerging market economy and a major player today, so probably.
I think crypto is not going backwards.
Yeah.
Crypto is going forward. So even if they regulate it, it's still going to be going forward. And this type of study that I just presented gives you more ways on how to use it and use it effectively. So the Indian economy or the Indian government, like the US government, Trump ordered, says, I want my team to take a look at creating a crypto reserve. That was a big move. And I know other countries, other governments are doing the same. So it's time to get people who understand it at the government level and know how to take advantage of it for their respective countries like India, and do what is best for India, because sometimes the beauty of crypto is that when it's mined and let go, it's not owned by anybody, right? So it's not like a Chinese crypto, or it's addressing a specific sector. If it's a service sector need or a technology advancement need, or it's addressing a certain need and people are investing because they how that is solving a mega problem in a mega way. So it's good time for maybe India to look at, okay, now how do we take advantage of these cryptos and stuff that are not going backwards, they're going forward? How do we put enough of expertise, train people, understand how to take advantage of it? I think that's the way forward. I don't know if I answered the question correctly.
Yes, sir. And thank you so much for providing us a lot of insights. And this will surely help researchers like us to take the things forward. And we'll take your recommendations as to a lot of research has to happen in this area that can contribute to policy making in the days to come. Thank you so much.
Thank you very much.
So formally, I will request our student executive, Nandan, to take over from here. Thank you so much.
Good morning, everyone. It gives me immense pleasure to deliver the vote of thanks for today's insightful and thought-provoking webinar. First and foremost, I would like to express our deepest gratitude to Dr. William Ganje, Professor and Chair at North Dakota State University, for taking the time to join us all the way from the US and sharing his deep expertise on the strategic role of cryptocurrencies in hedging and diversifying portfolios, especially in the agri-energy space. Your insights on volatility patterns, correlation dynamics, and the future of DeFi in commodity markets truly broadened our understanding and sparked new perspectives. To our patrons, Engineer N. Ramanuja and Shri V. Murlidhar, and our beloved principal, Dr. S. Satyanarayana, thank you for your unwavering vision and encouragement. A sincere thanks to our respected faculty members, especially Dr. Pushpa PV and Assistant Professor Dr. Pallavi, for their constant guidance and support. A heartily thanks to Ms. Geeta, Ms. Manjula, and Mr. Harish for their constant support in organizing this event. My biggest thanks to my fellow Wealth Wizard Club coordinators and members Amit Naik, Urvika, Shashwati, Deepika, Nikita, Vijeta, Shrivatsa, and tech team members Vishal and Mega for your dedicated effort behind the scenes. A warm thank you to all the participants who have joined us today and made this event meaningful. Thank you all. Have a great weekend.
Thank you.
If you have any closing remarks, Res, kindly. Also, I request participants to kindly switch on your video for a group photo. Again, Dr. William, thank you so much for your
Thank
time
you.
and to be with us, and a lot of insightful remarks from you, sir. Thank you so much.
You're welcome.
Ramanuja, sir, can we conclude, or if you have any closing remarks?
Can you hear me? Yeah. Dr. Ganje,
Yes.
thank you. Thank you for spending so much of time and
So we are not
making
able
this
to hear
subject,
you.
crypto, a very interesting subject for all of us. And I am sure whatever you have talked today will induce people like me to show more keen interest in crypto and understand better. And perhaps after a few months, Dr. Nanjay may again come back and revisit us, all of us, so that then there will be much more questions we can ask you because we'll be able to understand much better. Thank you so much. Thank you, Dr. Ganjay.
Thank you.
Thank
You're
you, Dr.
welcome.
Pushpa and whole team.
Thank you.
Whole team
Thank
of
you, sir.
group.
Yes.
Extraordinary interest you have taken. And
Thank you.
I am so glad that it was full participation. And I am very proud of all of you. Thank you very much.
Thank you. Thank you so much for your support, sir. Thank you. Thank you, Dr. William Ganje. And participants, we're taking the group photo. Kindly put your video on. And the feedback link is shared in the chat box. We request you to kindly fill the feedback form to receive the certificate of participation from our side. This was definitely a very insightful session. And again, I would like to take this opportunity to thank our management for supporting us in these ventures. And thank you, Dr. William, for joining us. Thank you
You're
so
welcome.
much. Looking forward for future interactions. Thank you so much, sir.
Thank you. You're welcome.
Thank you. Participants, kindly note the feedback link for the session is shared in the chat box. We request you to kindly fill the feedback form to receive the participation certificates. The feedback link will be open for next 20 minutes. And we do definitely require your participation and completing the feedback link for the certificates. Thank you so much. Thank you, Dr. William, for
Yes.
joining. Thank
You're
you, sir.
welcome.
Thank
Did you
you.
take the picture already?
Is the screenshot taken? Yes, sir. We have captured it.
Okay.
Thank you.
Okay. So we
Thank
can
you,
leave
sir.
now.
Yes, sir.
But most
Thank
of
you
them
so
have
much.
not switched on their video.
Yes, sir.
I only see the ghost images.
Yeah,
Why don't you ask them to open up, everybody?
we've been requesting them. Participants, can you please kindly switch on your video?
Yeah, one by one.
Participants are requested to kindly switch on the video again.
Yeah.
Thank you guys for having me
Yes.
talk to you guys today.
Thank you. Thank you so much, sir.
Yeah.
Thank you.
I see Dr. Sumitra.
Good morning, sir.
Good morning. Good morning.
Morning. Okay. All right. I'm going to leave. Is that okay?
Yeah. Thank you.
Yes, sir. Thank you so much. Thank you.
Okay. You have a good day and a good
Thank
week.
you. Thank you,
Good
sir.
weekend.
Thank you.
Bye-bye.
So, Dr. Pushpa and team, thank you.